This is Justin Pulitzer. This is my weekend video review for Sunday, May 15th, 2016. Videos have been pretty long lately. I'm going to try and make it a little bit shorter. If you happen to be catching this when it's right first posted and the resolution is low, just pause it, wait a little while, and reload. I actually shoot these videos in 5K. YouTube doesn't support that high. It only supports up to 4K, but if you aren't seeing this in a high HD rendering, just give it a few minutes. I assure you, you will be very pleased with the high resolution versions. Anyway, I'm going to jump in with the 6 market keys, get into the 7 Fed keys. I may commingle them. I've been doing that lately. I think that works pretty well because in the end, the Fed and the markets tend to be very interconnected. So the VIX here, we had been in a period of very low volatility, with brief spikes up. You can see into like the low 20s. And here, this was the flash crash. The market had an opportunity to transition from a period of more benign volatility into a period of higher volatility. But we have broken that trend and the channel, and it's been struggling to try to get back up into that area. Moving average overhead supply, anything below really 1785 to 1757, these like peaks here, is relatively benign volatility. It wouldn't surprise me to see some type of a spike up, get a little panic going into the 20s, 21s, but as of now, that hasn't been the case. We are in a bit of a cyclical move up in volatility, so that kind of favors that, but it doesn't necessarily have to happen. You can see you had these moves up here. You had these very brief interludes, and then it kind of came back down rather quickly. So I think that's kind of what we're in for right here. The dollar, as measured by the UUP, is very important. You can see in 14 and 15 there was a really big rally. It since has leveled off. It's now in a bit of a downtrend. You can see it's making lower highs and lower lows. It now on Friday tried to jump back up into the channel a little. I think we were looking for a 50 MA test. It's a little revealing that it backed off with a topping tail here, and we didn't even quite touch the 50 MA. Let me take a look at that on the DX. That's the dollar continuing contract. I think we did get it there. Yeah. No, stopped just a little bit shy, and you can see this is Sunday night. It's open. So it wouldn't surprise me to see a little bit more move up in the dollar to get the to kind of get to the channel high. That might coincide with a little bit of panicky move in the market. We know that things like oil are priced in dollars. That could be a bit of an issue. This also would be interesting if it coincided with the Fibonacci retracement and then these relative lows. It seems to me though that the I don't want to get into the Fed just yet. I want to cover that with the bonds, but the higher the dollar rises, it's sort of an interesting conundrum. The higher the dollar rises, the more people are going to say, oh, the Fed is likely to raise. But the more the dollar rises, it makes the Fed want a weaker dollar and kind of makes them less likely to raise. So it's sort of an if this, then that. You can see in terms of stochastics, we are in a bit of an upswing, and we have not peaked out. In the past, we've gone quite high. This got very bombed out, and it's just been in a slow, gradual grind. So I guess as far as the momentum goes, there is a little bit potentially mo in the dollar. Here we go. This is really the big show, and I think this is what has confounded so many traders. I get so many messages from people. How is the market staying so high? Why is everyone so bullish? How are stocks like Coke trading at 26 times earnings, with a 3% dividend? And the answer is really here, the bonds. You can see, and I've shown this before, and I'll show it again. Let's show it in a weekly. This was the crash peak in 2009 when the world was ending, when the markets bottomed. And we have spent quite a lot of time, including now, up above that area. Just go back to a more timely phrase. So as long as this doesn't necessarily have to rally, although you can see we have now broken a downtrend after a double bottom, sort of looking like a W pattern, which would mean higher bond prices and lower yields and potentially higher PE multiples in terms of the market. The reason the market has really rallied and has stayed strong is PE multiple expansion, meaning we're not getting more earnings. If anything, earnings have come down or the growth of earnings has slowed, but the quality of those earnings has definitely deteriorated. But the premium, the multiple that traders and I guess funds or whoever investors are willing to pay for those earnings has gone higher. Why? Because it's sort of the only game in town. Bond yields are this low. It makes people less, I guess, they need to find return, and it forces them into risk markets. And the S&P and some of these quote unquote safer stocks like the Coca-Colas and the J&Js and so on and so forth have nice dividend yields that are safe, and people are putting their money in there. How that's going to end, we all know in the end it ends badly. Coca-Cola, it's already, had a bit of a pullback. It held trend, however, perfectly. Now rallying, it looks like it's going to, fill the gap. Holding the 10-day here, this has been up quite a bit. These stocks, I wasn't planning on talking about these, but you can see J&J broke out. It's, these stocks are up quite a bit. Over, let's see, a 10-year period, this thing is basically at all-time highs. So they have definitely been rallying. They're trading at multiple, premiums to chase that yield. Anytime anyone ever reaches for yield, it always ends badly. This can too, but this insanity could last quite a while. The Fed, we know, is not reaching their 2% inflation targets. We know that GDP growth is below, maybe 2%. So the onus on the Fed to raise rates, and here I guess I'll jump into the 7 Fed keys a little bit, is for them to be more accommodative. Why is that? Well, you've had a jobs number the last Friday. Everyone seems to have forgotten, not this past week, but the week before. We had a jobs miss and revisions down, and the internals of those numbers were not good. There's still a lot of part-timing. There was a removal of a lot of government jobs, and I think the average hourly work week was like 34 and a half hours. Anyone under 30 doesn't qualify for Obamacare. So a lot of companies are hiring and they're part-timing or they're offshoring, and I think that regulations and the economy that we're in, we've all seen now the blow-ups in retail, in Nordstrom's and Macy's and so on and so forth, and the Gap. It seems more likely to me actually that these companies are now going to probably close stores and do firings and so on and so forth. That will not be good for the jobs economy. I mentioned the GDP, as measured by the Atlanta Fed, has been rather abysmal. The last 3 years have had very weak first quarters. The second quarter doesn't seem like it's doing all that well. ISM, there was a bit of a mix between the manufacturing and the service, but even though the manufacturing number was above 50, the employment component was sub 50, which is contractionary. So it shouldn't be a surprise that the jobs numbers have not been good. PMI, same thing, junky. Durable goods orders have not been great. We know that the Fed has mentioned housing and autos kind of holding up the show. But again, both of those are dependent upon low interest rates. If interest rates start spiking, those numbers will not look good. I've also proposed that I think that there is a seasonal pull-through that we've experienced because of the warm winter. And I know a lot of the demand, I think that was, I think it was pulled forward. I know a lot of construction didn't cease over the winter. The projects are way ahead of schedule. So, I guess that's good. It definitely has been, it's been good for the numbers, but it pulls, future growth. We've already had it. As you can see, GM, even with the kind of decent auto numbers, can't get out of its own way, and it's kind of listing and trending lower. So that's a bit of an issue. I just don't see how you're going to see huge investments without visibility, and there definitely has not been a lot of that. I'm going to flip back into the 6 market keys. The proxy for global growth is basically oil. So what do we have going on here? We have a fairly decent looking chart. It's made a little bit of an excess low. It's been grinding higher. It's been holding up. We've been in a bit of a consolidation range. I've thought we were going to see 49s. I could even make the case that I think we'll eventually see significantly higher, maybe even as high as 75, but I don't want to get into that. I take it from one level to the next. It's behaving fairly well. There is room, of course, for a pullback. We have a range low, which coincides with the channel. The 50 MA is briskly moving up. It's crossed over the 200, which is a good sign. I've shown you before here the 200 was a lot of resistance. It should now be support, and that's roughly around $40. So, the likelihood of coming back and retesting these lows diminishes as, you get moving averages that start bending higher. The 100 is bending higher. The 200 is reversing and starting to flatten to bend higher. The 50 is clearly higher. The 20 and the 10 are both below. Those are the kind of day trader ones. And we are above there. I think that the case for higher oil is, I think it's going to happen. It doesn't mean that we can't, have a pullback, but I do think that the path of least resistance is a little bit higher for oil at the very least. Same thing with XLE. We broke a very long-standing downtrend, a very ugly downtrend. You can see we spent some time here underneath, with the pullbacks were getting less and less steep, broke out, retested, now broke. It's just chopping around. The 200 MA, same bee's knees, was a lot of resistance. You can see once it snapped here, we never really saw it again. We couldn't even get strong enough to retest it, and now we are over it, and it seems to be holding. So I'll say XLE. And, of course, the 50 crossed the 200. I'll say as long as we're still within this trend line, and I would be a row buyer on a trend touch, I think or a 200 MA and preferably a 200 MA and trend touch would be good. I am more constructive on oil and oil stocks. Same thing with Exxon. I've talked about, here we go. Exxon being, my kind of my go-to stock in oil. You can see it's been looking a little bit above this channel. There's definitely room for pullback. I would be interested in selling some out of the money puts somewhere between 83 and like 84.70. So let's just say 83 and 85. If there's a pullback in Exxon, I'd be interested in selling out of the money puts in that area because I do believe that Exxon is going to see 100 again. I just don't know when. You can see we're in a bit of a channel here. It just seems to be doing the slow grind higher, and I expect that to continue. I would be a BTD guy there, meaning buy the dips in Exxon. One of the things that has not been acting well is China. This is the Chinese ETF. You can see we had the big breakdown here, retested this past support, and it broke down again. We rallied back up here, kind of similarly, retested the breakdown point, and now it's coming back down. There is very long time support for the FXI. You can see down here in the 28 area. I mean, yeah, at 19, it did get down there in the crash days, but this was a recent low. We kind of had a smidgen of a look below and fail. It went back higher. So what I'm thinking here, and it has been respecting fib levels. You can see we got to the 50 MA. I'm sorry, the 50% fib. It had responsive bounce. I'm looking for something in this area to be a buyer, somewhere between the 30.81 and the 29.62. I'll be. You can see there's a very prominent gap fill right here at 29.07. If we start pressing down further into here, I'll be looking to sell some out of the money puts into that area, at least for a short-term bounce. I think that we could probably see one. This is sort of the 800-pound gorilla in the room, the FXI. I'm sorry, the IBB. I want to show you on a longer-term chart. I think I got a little too long-term. There is a much longer-term trend line down here, which I don't think is in play at the moment, but you can see from this pullback this year, we had a head and shoulders top, a quite severe breakdown, the retest, and it's just been it's not been acting well. This looks like it's bear flagging. Potentially, you had one leg down. This could be two legs down, and maybe it's waiting for the final washout, which would be a 1.618 Fibonacci extension of this range down to where this broke, this all started from around 207.48 to 212.08. So here's the deal. This doesn't necessarily have to happen. If there was a move back up over the 271.77 and the 275.40, I would say that the lows here are a little bit more secure, although I am not a huge IBB fan. For many reasons, I think that you have all of the likely presidential, whoever's going to be the next president, Hillary Clinton, Bernie Sanders, and Donald Trump have all talked about lowering the price of drugs, and that to me means peak earnings. I know a lot of people talk about the cheapness of some of these companies. Gilead, for example, I think they only trade like 6 or 7 times earnings, but look at this chart. It's looking like a bit of a rounded top. You have a lot of important reference lows here. This is key. That PE multiple, which looks cheap here, if they have to lower prices or can't raise them and they have less R&D, this PE that, is cheap here around 6 or 7 might be quite higher if they have to, if those numbers start coming down. You can see we had the bounce. We have a bit of a topping tail in the bounce, and it closed below the low of this bar. The close of this bar. So it's a little iffy. I had said I thought we would hit this. There'd be some type of a bounce, and then maybe it breaks back through. The bounce has been rather lethargic. You really need to see it get over this 84.30 for a right or right out trade for a bounce higher. But this is looking a little iffy to me. It could really kind of get a little out of control. It is getting close to being bombed out stochastically. Keep in mind, this top peaked at 103, and it's down to, in the 81s pretty quickly. There could be some sideways chop here before, that break. So, it might not be so easy to chase. It's all context. How, if you ran up steeply or if you've come down, steeply, this has kind of been a bit of a grind. So we'll have to see how this plays out, but anything below 81, 89 to me is vulnerable, and you probably could take as a short, for a right or right out short. So that is IBB. We all know that the Fed is looking at some other stuff too. Janet Yellen basically in past speeches has said she basically looks at the S&P, the high yield bonds, which is HYG and FXI. So we know FXI is not doing well. This, however, is kind of holding in a little bit better. When this starts getting looking like this, you start having credit risk. People at least talking about credit risk, and they start getting nervous about defaults. It's good that this is sort of holding up, although we haven't taken out this swing low. This 50 MA and this 50 and 200 MA confluence is going to be really important in the next few sessions. If that could kind of hold up, yeah, there's some room for it to grind still higher. That is good. The fact that this hasn't really backed off hard, it makes me think that the possibility of a real, more serious correction is a little less likely. If this starts looking more like this, then you're going to start getting, something that is maybe a little bit more serious in terms of the corrections. In terms of the markets themselves, so this is my cluttered SPY chart, but I will say this. Keep an eye on these levels in here. Let me zoom in a little bit more. You can see we are in a cyclical downturn. There is room still lower in the stochastic, so yes, there could be further correction. But here's the key. I go by levels. It's all about the levels, baby. We have some very defined ones. Anytime we have had Friday closes below 204.12, we have had cascading effects later on. It happened here. And it happened here, and this was quite nasty. It did not happen this past Friday, which I guess the bulls can kind of hang their hat on. That is good. I said I thought we would run into some resistance up here around 210 to 11. We did. It has been pulling back. It has been rather mild. It often starts that way, and it can get steep, but it also can just consolidate here and launch still higher. the character of these, like these days and these pullbacks, other than one day in here, I forget which one it was, the breath has been really rather mild. It hasn't been like these trending day breaths, and it's been very push me, pull you type of moves. We did have a bit of a close below the 50, a little bit of a close below the downtrend. I'll tell you, the talk du jour has been, and I'll just, I hit it. I just like to, address all the issues, is one of these could be forming, one of these head and shoulders type of patterns, and we could have a bit of a breakdown. I have talked about there being some nuance to that, and that being this. Hold on. In the past, when we've made these moves up, this is very annoying, I have these alerts. You can see we've moved up here, and we had this big reversal part. They look a lot like these pattern. The difference here was that all of these were lower highs. See? The difference here is that this, granted it was only one day up, but this high did eclipse this high, and this shoulder is well above this shoulder. Usually when you want to have, when you want to kind of line up, get your ducks in a row, get your ducks in order for a head and shoulders breakdown, you usually want the right shoulder to be below the left shoulder, and you usually don't want to see one of these. So it's a little more nuanced. We've banged on this level here quite a few times. It's held up rather well. It held up all down here. It held up all over here. The more you bang on it, the more, like, sort of I guess the old saying is, the more you bang on the devil's door, eventually someone's going to answer. So the more times we bang on this area, I don't know how strong that support will remain. I've drew in a few minor trend lines, depending on where you draw from. We are right between them. This is very critical area of support. If we were to lose that, I think we would easily come down and probably look to be testing the 200-day and the next important level of support, the 201.90. You can see we've run up quite a bit, and the Fibonacci retracement levels are quite far away. So yeah, there could be a larger pullback coming. I did a poll on Friday. It was about 50-50 the results if we were just chopping in range or we had a big correction. So it's not like we have a very euphoric market. The expected move next week is roughly $3.26. I've often said with low IV, moves to the downside could be larger. That would roughly take you down to here. That would be the 201.51-ish area, which is roughly about the 200 MA, probably by the time we get there. And a move back up would take you to around 208.02. So that's roughly the this area. Anything below these kind of tops, I would say, is a little more vulnerable. If you can take out, I'll tell you this, if the market can take these two tops out, I don't know why we're not zooming in better. Let me make this a shorter time frame. Oh, because I'm on 5 years. That's why. There we go. Much, much better, I think. Let's see. Actually, it looks the same, but it is what it is. I think we're zoomed in enough. Anything that would take out these two highs, this double top, which was, I think, a poor high, would probably get us a retest of the old all-time high and a move still higher. I am not ruling that out at all. I actually think it's very likely still that we do see a retest of the old all-time high and a move higher. It doesn't have to happen, though. We could easily pull back. I always just go by the levels. I'm never really bullish or bearish. I just trade along the line of least resistance, and that always is basically where I see the levels being. These lows, this was 203.09 up to the 204.12. I have a proprietary level in there of 203.87. I kind of like this swing low as a key. This was 203.88. One tick above that proprietary level. I would say if you lose this area, the 203.88, you'll probably get some more aggressive selling down to here. If this holds, then you, I guess you can make the thesis that highs are still in play. Head and shoulders patterns or potential head and shoulders patterns don't necessarily have to play out. If this one did, and it played out to the tick, we could see, like I said, see the 201.90 and potentially down as low as maybe 196s to 197. So I do want to be a little bit cautious with a snap of this area. If this is a break, you probably want to either be testing short or at the very least trimming some longs. IWM is probably showing a little bit more weakness than SPY. You can see we are through the last swing low, which is not great. It is really right on this sort of trend. It's just the edge of a volume distribution, one and kind of coming into another one. So very key area. I would think the 108 here is sort of the must hold. If you want to play some put ratios, you can buy these and then sell, 2 times out of the money in the 105s or in the 104s near dated. I would think that a real snap of this, you could easily fill up the triangle to one of these reference lows. Usually, though, when you break from one range, you tend to come back at the very least and test into the middle of the next. I don't know if you want to count this as the middle or into here kind of as the middle. Interesting where these lows are. So that's where I think we could test in the 108s if this trend snaps. So it could be, a quick buck or two down. The Qs, this is what kind of has me, thinking maybe we're not as bearish as everyone might think. And I want to take this opportunity to show you. You can see we're in this big consolidation range. We're basically right in the, for all intents and purposes in the middle there. I've talked about in the past this area here being important, the 104s to 105s. You can see the NASDAQ is starting to get a little bit bombed out. We all know Apple has been having its woes and weakness. We are far from the trend line, so there is room for a quick flush down to the 100 level. I would think that happens if Apple, and that would roughly be the 50% Fibonacci of this entire range. So this could be in store. One thing I will say this, whereas IWM has been below this swing low, the Qs are not. And that's interesting because Apple has broken key support of 92. I'm going to go over that in a minute. And it's interesting to me that even with that weakness in Apple, we're not below the Thursday low, even with Friday's weakness. And we are still above this swing low of the 104.40. That is quite remarkable considering Apple, as we know, is a really big component of that. Wow, this is quite a messy chart. I apologize. You can see Apple is clearly way bombed out. I have been drawing some levels in there. Let me remove these drawings. They're not really that important at this point. Trend line. All right, so look at this. You're in a bit of a downtrend since the gap down. I want to just change these levels. Let me make this yellow. So you can see we had a bit of a look above the trend and fail. This was that Nikkei report. It was a gap and go down, and then again a gap and go. So Apple is really quite extended. I had talked about a row long. I was seeing a lot of hammers down here. Obviously that trade was negated. Just because something's a good risk reward or for an attempt doesn't necessarily mean it will pan out. So we have traveled a long way quite quickly. I would say Apple, you've got to be very careful with. Anything below this 89.47, I think Apple could trade down to the primary trend and the 61.8 in the range, which is roughly around 85.72. Below there is like 84s. So this is really the risk. I've drawn in a couple of channels. The kind of the stronger part of that, the less severe, is right around here. So I do think that this could be in play early this week if there is a move. However, I'm not that dogmatic. If we have a move above Friday's high and maybe above Thursday's breakdown, like above 92.78, I think is a right or right out long, because it would say that this breakdown was false. And then I would think that we would probably want to come up and retest at the very least this 100.72 and maybe like somewhere in the 103s, close to the gap fill and the 61.8 of the range. If this does wind up coming, so that's there's two ways to play Apple. One is, a right or right out short here, although believe it or not, I'm less inclined to play Apple short, but even on this break, just because we've traveled so far, I'd be more inclined on buying it down here for a right or right out long, or back over these 2-day highs for a right or right out long. I think that the short Yeah, you could get it. I don't mind. Listen, the options are fairly cheap. I don't mind doing some type of put spread for a move down there. But I am really more interested in buying Apple for a right or right out long at this point, just because it's traveled so far, really more down into the true support. So I like put spreads or put ratios for a move down to here, or just kind of a wait to buy it down here. I don't know if I really want to be outright short in that regard, just because it's really moved down a lot. You're really bombed out stochastically, and I don't think it would take a lot to kind of get this moving. I think that the people who played this here are a lot of kind of more day traders in short time frame who, they may say they have a lot of conviction, but if this stock moves back up over these 2-day highs, the same guys that are hated in short right now will be long, I assure you. That was Apple. Facebook, not 6A, although the Australian dollar is quite interesting. Considering we're coming down, it does imply a bit of a commodity correction right on the 200 MA. And how do you like how I fielded that? I wasn't even planning on doing it. Way bombed out, by the way. But we were really looking to talk about Facebook, and wound up talking about the Australian dollar. So hey, we can. That's how we roll. All right, this is great. So the progression line we've talked about, moves above it being unsustainable. We had to move right to it. Interesting that I had a chart on earlier, a 3-year daily, and it was showing the progression line. Wow, there we go. I think we got to use the 3-year daily from now on, because this is really showing the progression line where it should be. Interesting that different time frames showed at different points. Look at where the resistance has been. Any move above the progression line has been met with, some selling, and it's just been kind of doing a slow grind higher. We did make an all-time high. Anything above, this spike bar, the 120.79 obviously has the 1.618 Fibonacci extension of the 130.43 into play. However, I'll caution you, we've had these gaps and these kind of grinds sideways before, and they've met with liquidation breaks. I'm a little on guard. Options in Facebook are really cheap here. I would definitely buy puts or put spreads if you're long Facebook shares as a hedge against a move down, particularly if that head and shoulders plays out and the and the market rolls over. If you're looking for an entry on a pullback, we know that the 50, the 100 here and the 50 MA even here have been key support levels, so I would be looking for a right or right out buy somewhere probably on the 50, at least for the first time. If there's a break, particularly for a day trade, I think that the 50 is a very key average there. I'm a little hesitant chasing it here if you've missed the run the whole time, just because it's right up against the progression line. So if you're long, I would stick with it, and you could use the 10-day as a first stop, or anything below this range of the 116s. You probably want to be you want to be flattening up. Amazon, everyone loves Amazon, right? I mean, they could make a TV series called Everyone Loves Amazon. Amazon has gone through very long periods of time of, consolidation. It is broken out quite strongly. It's trading above the channel. It's trading basically at all-time highs. The one concern I will say here, if you're trading long, is that you have the potential here for a secure high, bit of a doji bookended by 2 lower highs. So if you want to try right or right out short in Amazon, I think you could use Friday's high as a stop, 119.25. If you want to play short against that, anything above that, you don't want to be involved in that, because we could be seeing the 833 move, which is the 1.618 of the range. I do think that Amazon will have some type of a pullback, maybe to the trend line, or maybe somewhere into this gap range. I would be an interested buyer, probably, considering this made an all-time high and how geeked up everyone is on this stock. I would think that the trend is at the very least, a right or right out long. I like playing put spreads and put ratios, particularly on down moves against that, to play for that. So it would be like buying in here and selling 2 times out of the money here. That to me would be really a high probability play. Netflix, this has been bombed out. Clearly, they didn't have the best of quarters. The good news is that it is basically down a super de-duper amount, and you have some relative support coming in a little lower. On a daily basis, though, there is some bad news. You had basically a double bottom here, a breakdown. You've had, a close below. You had a bit of a look above and fail. You're not. This isn't really a convincing breakdown. I will say this, and you have some higher lows here. I would be interested maybe as a right or right out long if you can get above Friday's high on Monday for some type of a bounce back, maybe to 90. I've thought for a while that this would see. Let me get back into the daily, a little bit more narrow time frame. I've thought for a while that this could see the 50-day moving average. I think at some point this gap will fill. I just don't know that we don't need to come lower first. I've often talked about the potential for Netflix seeing the primary trend and the breakout around 70. Maybe that happens around the next earnings. This could, list a lot lower. It's probably one of the more expensive PE multiples that, of course, with Amazon, and when you don't have a good quarter, they tend to, list lower. So I'm cautious as long as it's below the 88.21 to 88.11, these low hammers, it's probably more of a, you don't want to be involved. I don't necessarily know that I would be first initiating shorts, although I do think that you could play put ratios or put spreads for a move back down to this sort of 79.95 level, or like I said, right or right out if you want to try against the against this, this bar over the high of day, just because the high of day here was 88.59, which clearly is above the 88.21, and I would think that you probably can get a move back higher, and that could be that would construe this with the higher low as a potential false breakdown of range. Google. All right, so Google is I think Facebook is the reason Google has been struggling. They've been stealing market share. I don't really mess with Google when it's in range. I like to be a buyer on channel lows and a short on channel highs. We are just in the middle of the range. If you want to play row, you have a 200-day moving average to play against. I guess it's okay. I think that we could come down to the 680s, maybe the channel low. I would be a right or right out buyer on the channel low, though. I don't really like to play Google in range just because of all this kind of chop. There's really no rhyme or reason on that. So I don't feel I have an edge unless it's at a range low. Tesla. All right, so I hate to be an I told you so, but 265, I said that that's the sell point. We did get to 269, pulled back. I had said that we were a long way from Kansas Toto with regard to Fibonacci levels. We are at a big one here. This is an important one, the 50%. Stochastics are first getting bombed out. They're not 100% bombed out. I would really be more of an interested buyer, really close to the flash crash lows, which was 95. There was between 95 and 91. And the 61.8 is 90. So within that $5 between 95 and 90 is probably a better area to maybe sell some out of the money puts. It's doing a lot of consolidation here, so if it does break the 50%, I think you'll see that next Fibonacci level pretty quickly. I like playing put ratios for that move, or I like waiting on that to sell some put, out of the money puts at some for some lower levels, just because we've come so far. I think that there would be some responsive buys in that kind of reference area. I wouldn't surprise me if the market gets squirrely to see some type of an overshoot. Sometimes it overshoots the 61.8, but down near the 61.8, I'm looking for an area to sell some out of the money puts. Short dated, of course. Some of the ones that I've liked are this YELP. All right. So I've talked about this being a bit of an inverse head and shoulders and also a cup and handle. Played out really well. You got a big move up. Actually, this was a gap and go above the 200-day moving average, which is pretty bullish. I had been talking about 25.62 as a target, and it way overshot it. We got up into 27s. It's been pulling back quite, I wouldn't say aggressively, but it pulled back a lot. We didn't get a 200-day touch. I was kind of hoping for that. The good news is that Friday, given even the market was weak, YELP was way outperformed. I think that this is probably going to start listing higher here. I like playing right or right out against Friday's range. Anything below there, you probably want to be a little bit more flat. I definitely booked some profits up in here, maybe a little bit early, but I play with I have numbers. When my targets get hit, I never leave my wingman. The Top Gun term, you never leave your wingman. I always, at the very least, book some profits. Although I still do like YELP. I think it may want to fill the gap. It's very possible, but to me the pattern looks good, and I think that the stock is probably going to go higher. Same thing with not Gilead, Zillow. I was bullish on this. I will say this, we did get a gap right into the downtrend line. Talked about, it's pulled back here. You basically got a retest of the breakout. I don't know why I have this Fibonacci on here. It's not even the right level anymore. I have to adjust it. I'll do that live with you guys. The high here was 30.50. There we go. Again, a long way from the supports. You are getting a bounce. I'm still short some puts in here. I resold them on a move down here. They've worked out well. I would like to be a buyer of this. This may overshoot. You may get a trend touch, but I like a gap fill here. Look at this. This was really where this breakdown took place. You had resistance there, resistance here, again, all this resistance. So I think 25s, and I talked about this before they reported. I said 25s have been holding really strong. I had booked some profits in here, and I said it was really holding up better than it should have, and it did, and it's been holding. So I like short 25 or 23 puts. I think that area is pretty terra firma for Zillow. I'd actually love to see this now come up here, bust through the channel high and this earnings high, and that would be an amazing move higher. Like I said, though, that the market is a little bit iffy, so this might be looking to pull back. They had a good quarter. This plays into my theme of automation. I think these guys are really taking over the real estate industry. This is sort of like the Google for real estate listings, and I like buying this on dips. I'm a Zillow fan. Another one I liked for earnings was the SHAK. I was short puts as a long proxy. This was holding trend. We had a gap. It looked a little weak. I want to show you something. Gives you a little insight into how I think. Hold on. Maybe we need 2-day 5-minute. Let's see, 2-day 5-minute. All right. Here you had the gap. This pulled back quite aggressively. That made a little bit of a lower high pre-market, and then early on in the day, it was selling off. I thought that this sold off a little bit too much, and I was saying that I was a little bit nervous. But as the stock market weakened throughout the afternoon, SHAK firmed up and was strong. So that is a very good sign. I like also that this has a ton of shorts. I like that this basically got close to filling the gap. It didn't quite, but I like that it closed with a big hammer above the downtrend, and the body of the day was well above the downtrend line. So that's good. I think that this could wind up filling up the gap, believe it or not, up all the way up to 42s. There is some resistance in the 38s, but I like the SHAK. I think it could go higher. This stock has been the king of lack of follow through, but it seems to me that when it gapped down here after earnings, there was follow through. There should be some gap up to at least retake that level. So they had a beat and raise. Their numbers were really good. Their comp store sales were good. All good in the hood. One I've hated, and I never really like to pass up an opportunity to hate on this stock. GoPro, new all-time lows. I'll just say this. I had a lot of people who wanted to fight me with this stock. I never really liked it, and I said it would be a single-digit stock. They have no upgrade cycle, in my view. They have a pretty crappy CEO, in my view. He likes to buy yachts and unlock stock prematurely. I guess that wound up being smart because the stock has never looked back since then. But I just don't like this business model. There was a camera company out a bunch of years ago called Flip Camera. They sold to Cisco for like $600 million, and in the course of a couple of years, they wound up being a zero. They had to shut down the entire company. So, these are expensive cameras. They're at the cheapest in the 200s. They go even higher. Maybe they'll start making cheaper ones, but again, that's going to be bad for margins. They had drone delays. I talked in last weekend's video. I think there's going to be a lot of regulations for drones. So the longer these guys wait, the less of these things they might sell. They might come in, finally come out just in time for regulations and then not sell that many. So I'd be really careful with this. There'll probably be people who are looking to bottom fish this, and there probably will be bounces. I would be looking for those bounces to reshort though. Fitbit, another silliness stock. I referred to these stocks back before they really got going to the downside of silliness. I had talked about I was playing this long and I wound up getting out. I played it long for a little bit and then I wound up selling. I didn't like that all of the options were for everyone betting for a move higher. It since has gone lower. If they're showing some bottoming tail signs here, but if I were a short, I'd really be thinking at the very least a retest of the old all-time low and maybe lower. Once FIT gets under 10, I actually like this a little better than GoPro because I do think that there is a trend in terms of healthcare companies and this whole wearables market. I do think it's getting commoditized, and I do think that Fitbit is a little overpriced. They'll probably wind up having to lower prices and stuff, but I do think that there will be some type of a tradable bounce. If you're looking for a sub $10 job, I will say I'd rather likely be in Fitbit than I would than GoPro. If they had a pretty good quarter, believe it or not, they just had a terrible guidance situation. They did the same thing the last quarter, where it was a beat and guide down. Maybe these guys are into the sandbagging game, but I would rather, I guess if I had to pick, I prefer Fit over GoPro, but I don't really like either one of them. Anyway, couple of things on my radar to be watching for next week. Deutsche Bank. This has been a bit of a debacle. My thesis here, I had bought this down in here. We're almost back to where I bought it, which is not good. I talked about this being some of the pressure would be alleviated as oil rallied. It did, and then it's been coming down a bit. These lows really need to hold. One thing is cautioning for me is that Credit Suisse is already below that channel low and the last swing low. So if this doesn't really kind of get its mojo back, if we start losing these lows, this is not going to be a good scenario, a good situation. I think a lot of these things just rallied a lot, like the FCX, for example. I had been long this, and I think I sold it a little too soon. I had been talking, I took profits in the 11s or 12. I forget exactly where it was. But it wound up pulling back, and then it really ramped. Again, a long way from the primary trend. We did break the secondary channel. I'd be an interested buyer, probably somewhere near the 50% fib for a put sale and the 200 MA. I think if we could see that low again, I would be an interested buyer. Maybe it even gets to 61.8. But I don't know that it necessarily will. This looked like it was some important past support. I would think a 50% fib and really kind of near the channel, the trend low and the 200, this area to me seems like it would be an interesting area to sell some out of the money puts. Anyway, that's my story. I'm sticking to it. Glad I kept this video under an hour, although it is quite lengthy at 48 minutes. If you're not following me, follow me on Twitter. My handle is @JustinPulitzer. Please leave some comments for the video. I always like feedback to make it better. And be sure to hit the subscribe button below. You'll get notifications when I post new videos, Periscope rebroadcasts, and special edition videos. So you'll get to see all that. Anyhow, let's have a great week. Just stick to the levels. Try not to overthink it. Just stick to the levels. That's really my advice for this week. It is an monthly options expiration. Those do tend to be more bullish. If it winds up being bearish, that is very maybe more bearish, because there usually is option hangover that follows the direction of the expiration or whatever the following week. So this is going to be a really important week. Those 204s are really key in SPY. And that's my story. I'm sticking to it. Cheers.